If you're looking to buy a home and you're gonna need a mortgage for that home, well, you should expect the lender that you're speaking with to need to review your income in order to qualify for a mortgage. But what happens if you don't have quite enough income to qualify? Well, I'm Brand the Mortgage Man, and I've helped more than 10,000 home buyers over my 20+ year career in mortgages. And today, I'm here to help you by showing you exactly what we can do in those real life scenarios to help get you qualified when you're short on the income necessary to meet the purchase price that you're looking for. So here's how I would handle those situations. And these are real life examples of things that I've done and worked with buyers to do to make numbers work. So let's just give you this example where maybe you make $5,000 per month of income, but the monthly payment for the price range that you're looking to qualify for is $3,000. Payment, income. So if you've watched any of my other videos, you know that part of what a lender does when they're looking at your income is they look at your debt to income ratio. So I'm gonna keep this simple for this example and not factor in any other debts that might exist. Keep in mind, you may have student loans, credit cards, car payments, right? Those are legitimate expenses that you could have on a monthly basis. So it's unlikely you have zero expenses. However, just for simple math, I'm only gonna do a comparison between the mortgage payment and the monthly income. So what we're gonna do first is we're gonna look at what your current debt to income ratio is. Now, depending on the type of loan that you're looking to get, there are different limitations on debt to income ratio. I'm gonna just remind you on what those are, but make sure to check out my other videos and subscribe, where I actually show you exactly what's required when it comes to debt to income ratio, depending on the type of loan you're looking for. For this example, I'm just gonna say for FHA, your housing debt ratio, which is what the housing payment compared to your income, can't be more than 47%. And for conventional, your debt ratio can't be more than 50%. Now, this 50% number, just keep in mind, is really gonna be credit score driven. The better your credit, the closer you can get to the 50% number. If you don't have great credit, that number is likely gonna be lower. But these are just the guidelines. Let me put this here as a reminder of what this is. DTI, debt to income ratio. Watch my video on what that means. To figure that out, I'm gonna take your payment, divide it into your income. This is monthly, by the way. And the debt to income ratio for this scenario is 60%. Now, if I just told you that if it's an FHA loan, it can't be more than 47, and for a conventional, it can't be more than 50, well, we know that 60% is not gonna work. So how do we make that work if you have no additional income? So there's a few different things that can be done. The first question that I ask someone in this situation is, first, do you have any other sources of income that maybe you haven't talked to me about? Because it's surprising to me, but it happens a lot, where I'll talk to someone about their income and they'll talk about this income, the $5,000 a month, which is maybe their salary, right? Money they receive from their job. But maybe there are other sources of income that we consider that they haven't talked about. I'm gonna give you some ideas. It could be child support. It could be alimony, right? Those are the two most common that I see that aren't brought up initially. Now, some others might be SSDI, so Social Security Disability Income, right? Something that you may not think about. Believe it or not, you can use food stamps. So if you're receiving food stamps, that can be used toward qualifying as well, right? So these are some non-traditional income types. By non-traditional, I mean they're not from working, right? Just keep it simple. This could also include things such as pension, right? You may be a veteran or you receive VA disability, right? This list goes pretty long, but let's just say that you don't have any of these additional income sources, right? When I asked you, or your lender asked you, what is your income? You said all of your income, right? And maybe you only have your job. So in this case, we're using the $5,000. So the first thing I would say is, well, do you have anybody that's related to you that would be willing to go on the mortgage with you? They do not have to occupy the home. They're what's called a non-occupying co-borrower. So it's someone that we would put on the loan, use their income, their credit, potentially their assets to help qualify, but they're not gonna live in the property with you. It's pretty common actually, and surprising to me, that there are a lot of situations where there's a parent or a brother or sister that's willing to go on the loan to help their child or help their brother or sister qualify to buy a property, right? But let's just say maybe you're not in that position. Well, what's an alternative? Well, another alternative, and you may not be in a position to do this, but I'm just gonna throw it out there, is having someone set up a trust in your name, right? What I mean by that is you can have a trust where you're the beneficiary. And what happens is the person who establishes the trust, let's just say it was a parent, has to be in a position where they have a decent amount of assets, money, in order to set this up for you. And they have to be willing to give you that money. That's very important. But let me just say, in this situation, they set up a trust, and in the trust bank account, to make up a number, let's just say that they put $37,000 into the trust bank account. So we as a lender can take this balance of $37,000, divide it by 37. And the reason I use 37 is a lender can consider something to be income if we can show it has the ability to continue for at least 36 months after you close on the property. So the reason I say 37 is because what's going to happen here is you're going to create $1,000 per month of additional income. But if you only put 36,000 as an example, then that would only mean it would continue for 36 total months, but you have to receive an initial distribution prior to closing, which is month 37. So essentially, you'd want to have enough money in this trust account to continue for 37 months, including your initial distribution of $1,000 in this example, to qualify. But I can use this income, or any lender for that matter, can use this income immediately after you receive the first distribution, which would happen prior to closing on a home, toward qualifying. So if I took this $1,000 and I added it to the $5,000, right? So now we have your $5,000 salary plus your $1,000 is giving us $6,000 a month of income. We said the payment is $3,000 a month. So now we're going to divide by the $3,000 per month payment. And now our debt to income ratio is 50%, which would qualify for a conventional mortgage. You didn't have to go get another job because you couldn't use that right away anyway. You didn't have any other source of traditional income. You didn't have any other source of non-traditional income, but you had the ability to get assets to create income, right? So that's one way in which you can use assets to create non-traditional income and help you qualify to purchase a property. Now there's an alternative to that. So that's a trust, right? That's using assets to establish a trust, taking a distribution from that trust to qualify for a property. Now, what's an alternative to that? Well, maybe you're someone who's lucky enough to have a substantial amount of money in the bank. Maybe you have no traditional income. Therefore, your debt ratio obviously will not work. You have no income, and the payment's going to be $3,000 per month. But let's just say maybe you had a recent settlement. This is a real scenario, actually. I had a client who got a settlement. They were in an accident, unfortunately, and they received a large settlement. They had no income, but they did receive $600,000 as a settlement. So this money was in their checking account. Well, there's another mortgage guideline called asset depletion. And what that means is we can take this income, divide it over 24 months. And what that does is it gives us income from assets. So let's just say 600,000 divided by 24. Or sorry, 240 months, I apologize. Gives us $2,500 per month of income. Now this $2,500 per month is clearly not going to qualify us for a $3,000 payment. However, if this property is not going to work, at least having this income created from the assets, in this case, doing asset depletion, notate what that is, makes it somewhat possible to buy something. Now keep in mind, if you could combine this with adding someone onto the loan as a non-occupying co-borrower, it could potentially get you to the point of actually buying a home and qualifying to buy that home, where previously you were not in a position to do so because you had no income on a monthly basis. So I can get into much more detail on other ways to create income from assets and use your assets as income. And if you have a scenario that I didn't touch on in this video, I likely didn't because I tried to keep it simple for you, make sure to leave a comment below. I do respond to 100% of the comments on my videos, or just reach out to me directly. Make sure to subscribe to my channel for more videos like this one and everything mortgage and real estate related.